Hi, I'm Michelle. Welcome back to Finally Revealed. In this episode, I want to talk about equity. Equity in the sense of an asset interest. Equity is basically an ownership interest. You talk about equity in connection with real estate or real property. You talk about the part of that asset that you actually own. In the US, we typically buy a house with 20% or more down, meaning that of the cost of the property, 20% of the total value is paid in cash, and then 80% is borrowed. The percentage that you own increases in a couple of different ways. One is by the principal that you pay down on the debt, meaning the more you pay down, the less you owe against it and the more equity you have. Your equity rises as you pay down the debt. The other way that you can increase equity is by property values going up as a function of the local economy or as a function of what is surrounding the area. If the area is improving overall, it's becoming more popular, or it's becoming more improved in the way that there is actually new construction, or if it's improved by enhancements to the buildings around, or they're torn down and their higher value properties are built around your property, that can enhance the value of your property. And then also improvements on your property, either other buildings or improved finishes, remodeling parts of it, improving the exterior, the surroundings can also increase the equity. Other types of equities are involved when you talk about a company, typically a corporation. When I buy into a corporation, I am investing capital as a stockholder. And the stock that is issued to me is a representation of my equity in that business. One important distinction is that equity is not the same as debt. You watch Shark Tank on TV, the sharks are evaluating the people who come in and making proposals. Usually they are asking for a certain amount of money to be invested by one or more of the sharks in exchange for a certain percentage of ownership in that company. That is different from debt. So as equity, you don't have a guarantee that you will recover or realize cash for that. That capital is maintained either in the form of an asset or a book entry, and the asset could be cash or it could be other items. And they are not entitled to pull that out and receive that necessarily until the company is sold, or it gets into a situation where it might pay off some dividends, which is a percentage of profit that the board decides to give to the shareholders. But ultimately, they're not entitled to pull money out. That money has to stay there. That value has to stay there to sustain the company. And it's only if the company is sold that they receive a return on their investment in the form of their equity. So also when you look at Shark Tank, sometimes the sharks will say, I will loan you money for an interest rate and a guaranteed payment, but I won't invest for a percentage. And that's because they might believe in the company, but they want a guarantee that they're going to get their money back. And when you invest outright and you're infusing capital, you don't have that guarantee. You have an ownership interest, so if the value rises and at some point either you sell your interest to someone else who pays you, or the overall business is sold and everyone who owns it gets paid, that's how you would realize your equity, but it's not a guarantee. I hope that this is helpful to you to understand this concept. If it was, give me a thumbs up. If you have any other questions about this, please leave them in the comments below and I'll be happy to answer them. Share this with someone if you think it might be helpful to them, and please subscribe. I'll be with you next time. Thanks for watching.